I'm going to start with big picture macro questions, and this one's going to be focused to Ken and David. So the Federal Reserve has taken a hawkish stance as it relates to inflation and their intentions to raise and shrink their balance sheet. So do you think the market has reacted as if we were going to get the worst case scenario, or do you think they are not pricing in enough Fed actions?
I'll go first there, Mark. Thank you. And I think the Fed, entered into this behind the curve. Inflation has been a part of the system in 2021. And because of the fact that they entered kind of late, I think they turned more hawkish than the market was looking for. So part of this is looking back as when they were in QE mode instead of QT mode today, when Fed Chairman Powell said, I'm not going to start thinking about raising rates. And I think now we've taken the exact opposite. So I think part of this might be jawboning, that they want the market to move, which it has in both the short end and in what we've seen in the 10-year. And the market is doing some of their work for them. But I think the market for the stock market, is assuming the worst case, that we will continue to raise rates, not only on how the dot plots have laid out, but also maybe we'll slip in a few more. And a lot of talk was about 50 basis points a couple weeks ago for the first rate hike in March. And we just don't think that it's going to be that 50. And we think the Fed will at some time go back to saying they're data dependent. So they want to show a strong start, but the market is thinking that we're going to be thrown into a recession because the Fed is just going to pile on too much on the interest rate picture.
So let's talk about the active versus passive management debate. And this one's for you, David. We're deep dive fundamental managers, so we can't get any more active than that, right? So is there anything you see in the market that bodes well for active managers over the next several years?
There's quite a number of things. And first, I should say, if you look back over the last several years, you look over the last 5 years, small caps growth, active managers have beat the benchmark. So it's 5 years in a row. So we're seeing that right now. And some of the reasons are markets have become very concentrated. Top 5 names constitute more than 3 times the whole Russell 2000. Top 5 names greater than 3 times the whole small cap market. That breeds inefficiencies. And when that occurs, I saw that occur in energy. A couple years back, energy became so small, it was less than 4% of the S&P. What happened then was 2 things: reversion to the mean, and some of the companies started thinking about, well, what do I need to do? And on the energy side, it was, well, we're going to cut back on production, we're going to have capital discipline, we're going to have M&A. Well, a lot of the same things will happen as you see that reduction in size for small and mid caps. In addition to that, it breeds inefficiency because people are focusing on large caps. They're not really focusing, and research is not going towards small caps, which breeds, again, more inefficiency. And when you look at trading, an important component is we had JP Morgan several years ago look at trading and who's doing the trading. They came back and said 85% of the trades were done by algos, ETFs, indexes, non-value fundamental focused entities, all focused on price. And when you're focused on price, well, what do? You get a lot of volatility, which is exactly what we're seeing. So you got a market structure right now, which is breeding that volatility because it's focused on price, whereas managers like us are focused on growth and on fundamentals and valuations. And ultimately, Benjamin Graham said, in the short term, the market is a voting machine. In the long term, the market is a weighing machine. So in the long term, what matters is fundamentals.
One of the economic headwinds to recovery has been labor, right? Labor issues, especially in the service industry, in particular restaurants. So can you talk about what you're seeing as it relates to those labor pressures, rising costs, shortages of workers, and does it have broader labor implications, good or bad, moving forward?
I think universally in our discussion with business leaders, throughout 2021, the commentary was that this is the most challenging operating backdrop that they've experienced in their working careers, right? So Alpha, Delta, Omicron, the ability to hire, retain labor, get your labor and operating hours, everything aligned correctly, on a week-to-week basis has presented a tremendous amount of challenges. The labor backdrop in particular, throughout 2021, and this was according to the Bureau of Labor Statistics, wage inflation accelerated in every month of the year, started out mid-single digits in January, ended the year up mid to high teens. So pretty notable acceleration. I think really what was driving that is that we were seeing a demand recovery, but we weren't seeing labor return. I think a lot of the restaurants and services industries were hopeful that once we saw the unemployment benefits lapse at the end of September, that we'd see kind of a quick to return to work. When we didn't see that happen and demand reaccelerated post-Delta, they really had to lean into wages in order to get the labor where it needed to be. Post that, I would say in that October-November timeframe, pre-Omicron, we did start to see some notable improvement in labor and labor participation in the restaurant industry. I think universally, everyone cited improved staffing. But I think the good news is that, despite all the pressures that we've seen, over the better part of the last 12 months, the restaurant operators have been dealing with wage inflation for decades. We've been on a path in many states towards minimum wage increases. And in all the conversations that we're having, particularly as we get into the middle of this year, I think there's some optimism while we still expect inflation as we lap those particularly high rates in the back half of 2021, that we're going to start to see those wage pressures normalize back to historical rates. Part of our optimism on the consumer space is because we do think the wages are going to be a continual driver of spending. But we also think that you're going to see, as a result of the wage increases and the services industry's efforts to improve benefits, we do think believe we're going to see staffing levels start to improve more meaningfully as we move away from Omicron.
We've all been frustrated in our daily lives about the supply chain issues. Whether it be at the grocery store, the furniture store, buying a car, electronics, everything seems to be delayed. The shelves are bare. Are you seeing any signs of relief in the supply chain issues from companies that you're talking to?
There are signs there, Mark, but it's going to take a little bit of time. And I think it's going to be hard for us to see those inflation pressures coming down and becoming contained until those supply chain issues get better. I mean, so you could see it in things like Stacy was talking about labor. Businesses are learning to cope with it. And in some cases, I think the better companies are actually getting smarter about it. We recently talked to a company in the consumer packaged goods industry that said that during the Omicron wave, they've had double the caseloads that they've had during any of the other prior waves of COVID, but they've been able to achieve a 30% higher level of production volumes by being smarter and being more prepared and proactive about how they're going about planning their operations. And hiring activity has been strong out there, but turnover remains really high. Quits rates are at all-time high. It's trending higher. So getting the labor situation, as Stacy mentioned, into more of an equilibrium level is going to help a lot. And the other factor is really getting those inventory to sales levels back to normal levels. They're at record lows. So what helps? What's going to help that get better? Well, it really comes down to two things: time and consistency. It's going to take a little time to work these issues out, and more consistency in terms of having the disruptions die down related to COVID, related to weather and other exogenous factors. Some people are looking toward potentially autonomous vehicles as a savior. Unfortunately, we think that's several years away. But where I think we'll come in is getting those transportation networks more balanced.
Throw a little curveball at you and have a follow-up question on that. You mentioned the company that
Sure.
made adjustments because of what was happening with COVID absences and things. Has the pandemic, both the downturn and then sort of the abrupt reopening, has it created an opportunity for the team to see how their management has adapted and innovated throughout all of this?
That's certainly been one of the challenges and one of the reasons as the economy is reopening, we're getting back in the field. Still doing a lot of Zooms like this, but trying to get back out to see the production facilities, understand where the bottlenecks are, and talk to management teams and having open, honest, and frank conversations to understand what the issues are and how they're working to resolve them, and looking for those indicators that the issues are being resolved. And we've always believed that there's no replacement for getting out face-to-face meetings with people, and that's still the case today.
Great. There's been a lot of talk about decentralized finance, DLT, blockchain, digital assets. You and Ken have been saying for a while that you believe this is transformational technology. Can you first tell us why, and then maybe give some examples of how blockchain in particular is already being used not only in financial services, but also in other industries that folks may not know?
Yeah, so we think distributed ledger technology will affect the banking industry similar to the way that the internet did, and that it's a software that actually creates efficiencies, whether it's through transactions or whether it's through back office operations. And we think we're starting to see those use cases begin to play out already. It'll first play out on the payment side, where we have multiple banks that are already using distributed ledger technology. And we'll also see it in some other areas. How are banks using it now other than payments? We see it really, the first adoptions are through a consortium of banks that were working with bigger technologies that are actually putting mortgages on the blockchain and doing securitizations using blockchain. And they can do it quicker, cheaper, and without a middleman actually having to market that securitization for them. So they're doing their own securitizations. But we think that continues, and we think the space grows out. And there's many use cases, we think, across the banking and financial services industry for distributed ledger technology and their software.
Great. Thanks, Steve. Let's kind of continue on that theme of digital assets, cryptocurrencies. Lately, they've been hit pretty hard since the beginning of December, and stocks that are digital asset sort of ecosystem stocks have traded down as well. Should they fundamentally trade in line with the price of digital assets? And if not, is that an opportunity for investors right now?
Yeah, they really shouldn't. If you look at where we've invested in the space, we're still invested in, and we always have, our traditional markets. Banking and financial services has always been 85% of the fund, and it will continue to be so. And we're invested in banks that have made investments within the space that are using the technology to drive revenues and earnings. And all the companies we're investing in make money, but that money is not driven by the price of Bitcoin or any other coin or token that's out there in the market. It's driven by the activity and the volume and the usage of that technology within their businesses and services. So what I think is happening out there is that because we don't have a ETF, and because there's not clear regulation around the digital asset space yet, a lot of institutional investors or individual investors are investing in these names to get access or exposure to the space. And I think as a result, when they see the price of Bitcoin or Ethereum or whatever token or coin out there going up and down in the market, they also sell off these stocks. And additionally, these stocks have sold off in line. They've had a higher correlation in this last kind of month or so with risk-on assets. So as we saw risk-on assets sell off, we've seen these kind of trade in line with that as well.